Hi there, welcome to Kneppy Invest. In today's video, I'm going to be talking about Doug. Now, this is not your younger brother or maybe your next door neighbor. This is a company that on the ASX with a name called Doug, D-U-G. And Doug listed on the ASX almost 2 years ago. I think it was August 2020. I have been following this company ever since then because what they do is really interesting. But on the other hand, what they're doing hasn't been that successful. In fact, their revenue has dropped over the past 2 years. On the flip side of that, they have done some cost cutting measures. And because of these cost cutting measures, the company is or was operational cash flow positive for the March quarter, hence why I'm doing this video. So let's get stuck into it. But the first thing I want to talk about is what this company actually does. Now, on first looks and based off their name, you might think this is a mining services company. Maybe they have those big trucks that dig dirt out of the ground, that sort of thing, just by their name. But that is completely wrong. So let's talk about what Doug actually does. Now, to be honest with you, when Doug did first list on the ASX, I went to one of the presentations or the website, and I was actually quite fascinated about what this company does. They have three business lines, and I'd probably prefer to call these verticals or maybe divisions: software, high performance computing as a service, and services. I'll talk about which of these business lines is producing the most revenue later in the video. And they do have a platform called Doug McCloud. And just based off the name, you might think this company has something to do with climate or weather. And when you look at the sales areas, there's a lot going on here. And climate is one of their sales area. They also have military and space, industrials, resources, health, education, research, and radio astronomy. So they do have a lot of stuff going on right now. Now, when you do go to the website, it's really fascinating about what they are trying to do right now. For instance, they are building the world's first climate positive high performance computing data center in Geraldton, West Australia. They're also accelerating the search for the first stars and galaxies. The Doug's algorithm optimization expertise enables radio astronomy data to be processed at warp speed. They're also supercharging medical research to advance human health, outsmarting bushfires with artificial intelligence. And what else do we have here? Sharpening eyes in the sky. Their code onboarding and optimization expertise produce a step change in Earth observation capabilities. So this company has a lot going on here, a lot of services going on. The other thing is, if you do look at their services, for instance, they have a HPC data services, geoscience services, seismic processing, full waveform inversion, have no idea that is, depth and least squares imaging, petrophysics, quantitative interpretation, regional velocity models. So a lot of these services, I have no idea what they do. So it does seem like they have a lot going on here, but the only thing is they're not being successful in what they do because revenue has been dropping over the past few years. We'll talk about that during the rest of this video. Doug was founded in 2003 and listed on the ASX 12th of August 2020. Probably you'd think that's pretty good timing just after COVID-19, the peak in that panic. But the share price of Doug has gone the complete opposite direction than what you would want if you partook in the IPO and have held onto your shares. Share price has dropped quite considerably. And we'll talk about that when we look at the chart. The managing director and co-founder is Matthew Lamont. He has a bit of skin in the game, 20%. That's probably a pretty good number. So you don't want too much, but you don't want too little either. So 20% does sound like it's a good number. And two of the major shareholders in this company are Perennial Value, 15%, and Regal Funds have a 9% holding in Doug. Current market cap at 48 cents. And keep in mind, share price has been quite volatile over the past few days, particularly yesterday on the 14th of June. Share price, I think, got down to 37.5 cents at the low. So share price has moved quite a bit, but a market cap only $56 million. So if this company does start making strides in what they are doing, this would be a very fascinating company to possibly invest in. So I am hoping they do make strides because what they're doing is quite fascinating. And the T code, could it be anything else than DUG? Now let's have a look at the financial state of Doug. I've already talked about how their revenue has been dropping the last few years. First time I actually did research Doug, their revenue was climbing, but something has changed in this company the last 2 years. Now, maybe it is COVID-19 related. I haven't delved too deeply into looking why at why revenue has dropped. But when you look at the trailing 12 months, revenue of 33.4 million, 12 months previous to that, revenue was 40.5. But when you also look at operating cash flow, it's not a good story here. They've gone from being operating cash flow positive to operating cash flow negative by a high amount. In fact, that operating cash flow negative was negative $4.6 million in the last 12 months. Highly unprofitable, so loss making of $15.7 million in the last 12 months. And that is a slight deterioration from the previous 12 months, $15.3 million loss. Net debt of $1 million. So they do have a fair bit of cash and a fair bit of debt, and they both cancel each other out. So debt of $1 million. They did do a capital raising a while ago, and some of that capital raising was used to bring that debt down to more manageable levels. Now onto where they are deriving their revenue from and where they actually are deriving their revenue. So this company is an international company with services all around the world. So they have those three divisions: services, software, and HPCAAS, or high performance computing as a service. Services is by far the best performing division in terms of revenue, $12.4 million. Software is at 2.9, and HPCAAS is at 1.7 million. All three divisions have seen their revenue drop from last year. That's also concerning to me, that there is some sort of negative trends in all three divisions. And there's also a negative trend in all geographical areas. Australia, United Kingdom, USA, and Malaysia have all seen revenue drop over the past 12 months. In fact, this is 6 months, 6 months data, comparing the last half year to the half year previous. But I just wanted to see how or which division is deriving the most revenue and where they are driving their revenue from. But the one thing we can get from all this information is they are having trouble in all three divisions in all geographical locations. Now, on to looking at the company's Appendix 4C. And typically, before I look at the most recent Appendix 4C, which is for the March quarter, financial year 22, I'm going to go back and look at their first Appendix 4C they actually did release. So when this company did list on the ASX, they weren't required by the ASX to issue quarterly updates. That changed in the September quarter, financial year 22. So this is the first quarter of financial year 22, even though it says financial year 21, it is financial year 22. So obviously the ASX did ask this company to start releasing Appendix 4C. And it wasn't a pretty quarter at all for this company. And one of the reasons why we have or did see the share price of this company fall like a rock around this period was because of this particular Appendix 4C. Receipts to customers, 8.6 million, and they burned through $2.1 million of cash. They also did a significant capital raising, a $9.9 million capital raising, and $5.3 million of that went to repay debt. And to be honest with you, even though they did do that significant capital raising, the cash on hand did not grow all that much. In fact, it only increased by $500,000. So obviously, one of the reasons they did do this capital raising was to decrease those debt levels. But based off the most recent Appendix 4C for the March quarter, financial year 22, things look like they could be turning around for Doug. Receipts of customers climbed to almost $10 million, so up $1.2 million. I've already mentioned they did do some cost cutting, and you can see that with a lot of these spending. So product manufacturing operating costs down $300,000, staff costs down $2.3 million, administration costs down $150,000. They also repaid debt, $500,000 of debt. So is this company becoming more efficient? So they've increased their receipts but decreased their spending. So this could be a good sign for Doug moving forward. Another possible way to look at this is they've decreased their cost, which really hasn't had an impact on this particular quarter, but we might see a decrease in receipts the next few quarters because of this decrease in spending. I don't know yet, but I'll keep an eye on Doug's June quarter results just to see if we do see a troubling trend in receipts going backwards. Now, because they did were operating cash flow positive in this particular quarter by $2.3 million, so they were able to repay a bit of debt. But even though they did repay a bit of debt, the cash on hand actually did increase from $11.2 million to $11.8 million. So that's why they do have around about $1 million of net debt, because they're building that cash reserves. But again, they still have a little bit of debt. So things are going right for Doug right now, but the market is still a little bit hesitant about this company. You'll be able to see that in the chart. They want to see proof that this particular quarter can be maintained in the next few quarters. And I am thinking that as well. I want to see a very similar quarter for the June. And if I do see a similar quarter, that would be really good news for this company. And hopefully the market might turn its opinion around for Doug, the company. Whenever I am looking at an Appendix 4C, one of the sections I always look at is section 7, and this is focusing on the debt a company might have. And the reason I focus on this is I don't want any of these small cap companies to have unmanageable debt on their books, because sometimes the interest rates they need to pay on these debts or these debt facilities can be high. I have seen interest rates as high as 20%, which does make sense because these small cap companies, particularly these unprofitable small cap companies, have much higher risk attributed to them. And anyone who provides these companies with debt wants some sort of payoff to overcome that risk profile of that company. So I do understand why some of these companies do have fairly high interest. So let's have a look at Doug's debt facilities. Both or most of them are with the Commonwealth Bank of Australia. So at this point in time, total financing facilities at 12.9 million. Also, unused financing facilities is sitting at $7 million. And hopefully they won't have to use that, because if they do need to use those unused financing facilities, either they are burning through a lot of cash, or the best case scenario is they are making an acquisition. So two of the main debt facilities is with the Commonwealth Bank of Australia, a term debt at 12.1 million, which is at LIBOR rate plus a 3.75% margin, so at least 4% interest rate there, and revolving facility of $7 million, that's at a LIBOR rate plus 2.95% margin. Both of those facilities have a maturity date of 1st of July, which is only 2 weeks away from now. So it'd be interesting to see what they do with those two facilities. At this point in time, I don't think these debts are unmanageable for Doug, simply because they do have upwards of nearly $12 million of cash on hand. So $12.9 million of debt with $12 million of cash, it sort of washes each other out. So at this point in time, I'm not that concerned with the debt on hand for this company. One thing I am concerned about right now is just the overall negative sentiment in this company. This is the daily chart for Doug going all the way back to August 2020 when the company listed on the ASX, and the share price has been dropping ever since then. In fact, when they did list, about 5 or 6 days after they listed, the share price did reach a high of about $1.54. And that was the high in the share price for this company. Share price has been decreasing ever since. And that first Appendix 4C I did show you from the September quarter 2021 or financial year 2022, that would have been released in October. And that was a period in time when the share price was dropping like a rock for this company. And one of the reasons it was dropping like a rock was because Doug was operational cash flow negative, burning through a lot of cash. The other thing is the revenue was dropping. Now, we have seen the share price wanting to consolidate over the past 6 to 7 months, but recently the share price has dropped in line with the overall negative sentiment in the market. And on the 14th of June, my birthday, share price did actually reach almost 37.5 cents, but did recover to about 43 cents. So that would have been nice buying. I actually did see this in a lot of companies. There were, when you look at the candlesticks for a lot of companies on the ASX, there was a really long tail. So there was panic selling yesterday, and that could have been a little bit of capitulation, but it also could be a bad sign that there is an understanding out there that now is not the right time to be in equities markets. So we did see the share price of Doug recover and finish at 43 cents. But share price did reach an all-time low the 14th of June. No reason why share price will not drop any further from here, even though they were operating cash flow positive in this particular quarter or the last quarter. I need to see the company continue that momentum moving forward. And at this point in time, because of this negative sentiment, I'm going to put Doug onto my watch list, and hopefully I'll see some more really good quarters from this company in the future. That's all I have for this March quarter Appendix 4C video for Doug. First time I've really taken a close look at this company, even though they have been listed on the ASX for almost 2 years. This has been a share price has been dropping, and no real reason to do any research on this company because they have been operating cash flow negative for a while. Does look like potentially they are turning things around based off the March quarter results. But again, I've already mentioned this maybe twice in this video. I'd like to see that momentum continuing into this June quarter and then even into the September quarter as well. If you have any thoughts about Doug, the company, I'd love to hear them. So leave it in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.